Hello everyone, this is Rasmi and welcome back to my channel. Today we are going to discuss about a very popular investment option that helps millions of people to grow their wealth. Yes, we are going to discuss about mutual funds. Whether you are a beginner or looking to refine your investment strategy, this video is going to be very helpful for you. We will start from the very basic level. What is mutual fund? A mutual fund is a type of investment vehicle that pools money from multiple investors and invest in a diversified portfolio of stocks, bonds, and other securities. It is managed by a professional fund manager who make investment decisions on behalf of the investors. Now, how do mutual funds work? When you invest in a mutual fund, you are essentially buying shares or units of that fund. The fund manager then uses that money to buy a mix of assets based on the fund's investment objective. The returns or profit generated from that investment are distributed among the investors based on their shareholding. In simple words, when we invest certain amount of money in mutual fund, that money is invested by the fund manager and how much profit he makes from that money, that is distributed among us. This is how the mutual fund works. Now we'll discuss about the types of mutual funds. There are different types of mutual funds which are tailored to meet various investment goals and risk appetites. But here we'll discuss about only 5 because these 5 are very famous and important too. First is equity fund. These invest primarily in stocks and offer high return with higher risk. Since this invest only in stocks and we know stocks are very volatile, that's why here return is high as well as the risk. Risk is also high. Second is debt funds. These funds focus on fixed income securities like bonds, treasury bills, debentures, etc. And this type of fund is suitable for conservative investors. Conservative investors means the investors who don't want to take high risk, they want to take a moderate risk or low risk and they want a consistent income. So for them, this type of funds are very important and this type of funds are very suitable. Third is hybrid funds. These funds invest both in stocks and bonds and here risk and return both are balanced. Since it invests both in stock and bonds, it is called hybrid funds. Fourth is index funds. These funds track a market index like Nifty 50, Sensex, etc. This is a great option for passive investors. Fifth is thematic or sectoral funds. In this we invest in a particular sector like banking or pharma. If we can identify a particular sector which is going to grow and which sector is growing, then we can earn a handsome amount of money from this type of funds. Okay, now we will discuss about benefits of investing in mutual funds or why should you consider mutual funds. The first benefit is diversification. By diversifying, your money is spread across different investments, so your risk is reduced. Second benefit is professional management. When you invest in mutual funds, you don't have to take the investment decisions. A group of experts handle the investment decisions for you, so you don't have to worry about where to invest and how to invest. Third benefit is liquidity. Liquidity means you can easily buy or sell mutual fund units at any given time. Suppose you have bought some mutual fund units and those are in your portfolio. Now suddenly there is an urgent requirement of money. In this case, you can sell those units and instantly get the money. Fourth benefit is affordability. To start investment in mutual funds, you need not to have a lump sum amount. You can start investing with a small amount of as low as rupees 100 through SIP. Okay. Now we'll discuss about the risk involved in mutual funds. First is market risk. Since mutual funds directly invest your money in stock market, if market performs good, then your portfolio will also grow. But if the market performs poorly, then your investment will also perform poor. Second is liquidity risk. Some funds may have restrictions on withdrawals, especially the closed-ended funds. There are two types of funds, open-ended and closed-ended. In open-ended, you can buy or sell the funds at any time, but in closed-ended, you can do that. Third is inflation risk. The returns may not always outpace the inflation. This means when we invest in mutual funds, it is not sure that every time it will outperform the inflation. Sometimes it will underperform the inflation. Now we will discuss about how to choose the right mutual fund. The first thing you have to look after is your investment objective. You need to analyze your objective before investment, whether you are looking for growth or income or stability. Accordingly, you have to choose the right mutual fund. Second is risk tolerance. This means how much risk you can handle or how much market fluctuations you can handle. That is called risk tolerance. The third thing you have to see is fund performance. Review the past performance of the fund, though it is not a guarantee of the future success, but still you have to review the past 5 years performance of that fund in which you are planning to invest. Then you have to look after the expense ratio. Look for the lower expense ratio. Lower the expense ratio means lower fees, and lower the fees means higher potential of return. Then we have to look after the fund manager expertise. Look for a skilled and experienced fund manager. A skilled and experienced fund manager can make a big difference and bring a good fortune for you. Now, there are two primary ways to invest in mutual funds. One is systematic investment plan, or we can say SIP, and second is lump sum investment. In systematic investment plan or SIP, you have to invest a fixed amount regularly, that is weekly or monthly or quarterly. What benefit you will get from this? The benefit is it will reduce the market timing risk. Second is lump sum investment. In lump sum investment, you have to invest a large amount at once. It will be more beneficial if the market is rising. Now let us discuss about the common myths about the mutual funds. First myth is mutual funds guarantee higher returns. No, it is not necessary. They are market linked and they carry risk. Second myth is only experts should invest. No, anyone can invest, or anyone with some basic research and idea can invest. Third myth is SIP ensures no loss. SIP reduces the risk, but it don't eliminate it. Okay. Fourth myth is you need a lot of money to invest. It is not necessary. You can start investing with as little as rupees 100 per month. Guys, this was a very brief discussion about mutual fund and was just a basic idea about mutual funds. In the coming videos, we will discuss more about mutual funds and in more details. Till then, signing off. Don't forget to like, share and subscribe to my channel. Thank you.